Welcome to Module 6, everyone, in which we're going to delve into the subject of MACD neutralization, which is a repeatable pattern, by which we mean that whenever we encounter it, it tends to unfold pretty much in predictable ways and have the same general meaning. What happens in neutralization is, first of all, MACD will cross over in the direction of a fairly robust breakout move in price and follow the direction of price initially. So if price collapses strongly, you will see a bearish crossover on or above the waterline in the near background, and conversely, when you see price rallying, you will see that preceded by a bullish crossover on or below the waterline. MACD will then, as I say, follow price, and it will eventually go deeply overbought or oversold relative to the waterline, subsequent to which it crosses over in the opposite direction and issuing a fake-out signal in the process. In other words, a short signal, but we don't want to follow that to the short side because price goes sideways, and vice versa for a long setup. MACD will trend strongly towards the waterline with the appearance of solid angle and separation. Then it may touch up against it just barely, or even dip down to the other side before the next leg of the move. If it's a continuation move, you will see a third crossover lined up the same way as the first, or if it's a reversal move, some other type of setup. So let's take a look at some graphical representations of that phenomenon now. Okay, here's this graphic I was talking about, finally. So what we've done is we've kind of broken it up into three sort of segments or phases. This is what MACD neutralization will look like more or less in the case of a down move, the profile of MACD. So again, we start off with that initiating crossover, and in this case it will be a bearish crossover following price. It'll penetrate the waterline, come way deep below the waterline to here, at which time we'll get a secondary crossover, and MACD will cross over bullish, heading up with good angle and separation towards the waterline. Now, what will be happening on the price panel is that if we have some combination of moving averages, what you'll see is that they'll continue on down like this, okay, as my cursor is falling down from left to right. The moving averages on price will continue diagonally. They will not go in the same direction as MACD here, which is yet another clue that this is not a valid reversal event. This is just neutralization. So eventually we get to this point here, somewhere in the vicinity of the waterline, and if we're dealing with a continuation down move, we'll have a tertiary crossover. This is a three crossover paradigm, 1, 2, 3, and that will be aligned in the same direction as our initiating crossover way back here, although obviously not in the same area. So what often happens actually, which is quite interesting, is that even though the second move down on price might be just as far as this first one, or even farther potentially, MACD often will not come all the way back down to this swing low here. It'll often come up short, and then it'll cross over and head back in the opposite direction. And what that will provide is the opportunity to draw some divergence lines here. If we had a low on price here and another low on price here, but MACD was trending in the opposite direction, that'll tend to signify that price is then free to head up after this paradigm has played out. But in any event, don't want to mix up the information too much here. This is a three crossover paradigm on MACD, and this is more or less the profile it'll follow. It's important to consider what price action will look like while MACD is crossing up, neutralizing towards the waterline. MACD will often look very, very dramatic, like it's just punching up with extreme gusto here. But what you'll see on price, I've kind of drawn two potential avenues that it'll typically follow. Price will either just go absolutely flat line sideways like this, as indicated by this flat gray line, or it may actually drift up just a little bit, as indicated by this narrower black line, not necessarily constituting a full-blown retracement, although of course it might. but typically you'll see price just going kind of anemic on us for a little while. So what you're doing is you're comparing and contrasting the two panels at the same time. While MACD is neutralizing, it's punching way up with angle and separation, looking like a trend signal, which it's not in this case, whereas price is very flat and anemic and not really going anywhere special. Here's a chart example, and actually what's important to point out here, not just what the paradigm looks like on a chart with the actual indicators and price, but to show a contrary example to what I just talked about. What we see here is an initiating crossover, a bearish crossover on MACD, coinciding with a down move on price. So they're both moving in the same direction. And then we have the secondary crossover from below the waterline. Now in this case, MACD actually doesn't look all that striking or punchy or whatever you want to call it. It's just kind of lilting back up towards the waterline. It's not one of those big punchy moves. And the reason why I chose this example deliberately, because we have to be able to see these paradigms even in the ambiguity of real life day-to-day data. Okay, so these patterns don't always follow the clear textbook paradigm. Sometimes they're a little trickier to detect. But what you want to really take note of is the fact that while MACD is crossing over bullish, heading this direction, price has gone absolutely sideways on us. It's gone into this very narrow consolidation channel. Gone sideways while MACD is trending, albeit rather anemically, towards the waterline. Now, when we get this tertiary crossover just below the waterline, really confirmed by this first histogram bar to paint in red on the opposite side, it's a little bit obscured here, that coincides with the breakout of this little channel here, and then the two indicators, price and MACD, continue on down. And actually, the second part of the move is a lot steeper than the first part. But this is what it looks like in real life, and like I say, often you'll get a very dramatic punch up, but it doesn't always unfold that way. You have to really be able to read the pattern into sometimes ambiguous data. Here then is what neutralization will tend to look like in the case of an up move. So again, we divide it into three main phases. We have the initiating crossover of MACD, a bullish crossover in this case, typically below the waterline, which will outline the start of the up move. We'll then get the secondary crossover in the opposite direction, and this will more likely than not coincide more or less with the onset of the consolidation channel on price. Okay, when you get this initial bearish crossover, price is then starting to move sideways on us. MACD is then seeking out the waterline. It'll end up either just above, on, or just below the waterline, at which time, if this is indeed an uptrend continuation setup, you'll have the tertiary, or third of three crossovers in this paradigm, unfolding in the upwards direction, just like the initiating crossover back here. So again, a three crossover paradigm, one online with the trend, two counter trend, three again online with the trend. So that's kind of what it looks like in the case of an up move. Again, comparing and contrasting MACD to price. So what we see happening in the case of this up move is that while MACD is trending down following the secondary crossover, price again will typically go either flat or possibly drift down sideways just a little bit, but it will not again follow this neutralization cycle on MACD, which will look a lot more kind of severe than it really actually represents. So that's price and MACD in the event of a neutralization cycle in an up move. Chart example time yet again. It starts off to the left-hand side here with this bullish crossover on MACD, outlining the initial move up on price, price lifting off this 200 period EMA after having found support there. MACD follows price as they both kind of reach for the sky, and at the moment that MACD then crosses bearish, price goes more or less sideways on us, remains constrained within this consolidation channel. So therefore, we see this not as a bearish signal, but rather as neutralization. MACD is just reaching for that neutrality reading before the market continues on. And we know that not just from looking at this chart. We only have one trending indicator, which is remaining biased upwards, but we're looking at trend signals or trend readings on various other time frames as well. So then we get our tertiary crossover in the upwards direction, a bullish crossover just below the waterline, and subsequently we start to see some angle and separation opening up as per our trend channel, or rather our trend cycle concept, and that all plays out exactly at the moment where price breaks out of this trend channel. We start getting some closes above, and then we can see what happened, the continuation move. Price then moves up. Now, once that's all played out, we see another potential opportunity to take under advisement here. We see a fairly pronounced swing point here. We're going to play sort of fast and loose with it in terms of drawing a connecting trend line all the way back to this upthrust candle way back here, this lower swing high, and that'll give us a rising resistance line. We'll then look at what's going on with MACD. We've got a swing high here and a higher swing high in the background coinciding with this point, so we would draw the connecting line here, and obviously that would result in negative divergence. But would we want to jump on it? I don't know. I wouldn't have enough information on this chart to decide whether I wanted to try and trade that divergence signal. I wouldn't guess that I would actually, because there's no sign of a turnaround or a reversal here at all. I'd want to take into advisement signals on various other time frames. But this is exactly the kind of scenario where you want to apply some of those filters we talked about as to whether you want to try and trade a divergence signal or not. But anyway, that's not the subject of this chart. The subject is leg one up, sideways market, MACD neutralization, tertiary crossover, and then we're heading back on up again. Objection. Why did that trend continuation paradigm that I thought I saw unfolding on that 15-minute chart last night not continue on, but actually change direction and went the other way? Why did that happen? Well, okay, we know that all of our indicators and patterns and paradigms sometimes, well, most often work if read in context, but sometimes they don't. It's really important that you develop the skill for discerning a continuation setup versus a reversal setup, because once MACD has headed back down towards the waterline, it may cross over again in the original direction. It may not. It may set up for some type of reversal event. So what we want to do is start piecing together clues as quickly as we can. This is tricky business. It's not the easiest thing to do, but some of the techniques you might want to apply for trying to determine a continuation versus a reversal setup, and we'll show you the patterns for those in just a minute. You want to be aware of ABC patterns and use those in conjunction with trendline breaks. You want to look at other indicator readings as well. You want to read the trend with moving averages both on the same time frame and on higher time frames. So before we get into those techniques in a little more detail, let's take a look at the 4 different continuation versus reversal patterns. Here they are, and if you are an existing Forex Mentor member, this is not news to you. This is old hat. But if you're not, you should be aware of these patterns. These are ABC, continuation, and reversal patterns. There are 2 uptrend patterns. Slice it differently, there are 2 continuation versus 2 reversal patterns. So let's just go over those briefly. An uptrend continuation pattern is where you have an initial up move from A to B. The market then retraces somewhat to a C level before it rises up again, taking out the B level and continuing on up from there. A downtrend continuation move is just the inverse of that, of course. We have an initial down move from an A point to a B point. Price then retraces part of the way, hits an interim high, falls off from there, takes out the B level, and continues on down. An uptrend reversal situation, what you'll have is we have A up to B. The way we've drawn it is B to C. The market just drifts upwards just the slightest little bit more. It doesn't necessarily have to go that way. It can go totally flat line. But in any event, what you can see comparing and contrasting these two patterns, uptrend continuation versus reversal, is that from B, we don't have a very clear retracement move down. That's the distinguishing feature. It's not moving down on us, it's moving sideways to slightly upwards possibly, and then it hits the C point and then turns over from there. And then, of course, a downtrend reversal, just being an inverse of all of that, we have an initial down move from A to B. Instead of retracing up a goodly amount like we saw in the downtrend continuation pattern, from B to C, it's more like flat line to slightly down drifting. And then we get a turnaround situation at the C point, and price will then seek out most, if not all, of the losses that it made from here. So those are the four ABC continuation versus reversal paradigms, and they're important to keep in mind when you're looking at potential neutralization patterns on MACD.